Alright guys, welcome back to the channel. Today I'm going to be talking about a new strategy I just tried out. I'm going to call it the homeless option strategy because you don't need a lot of money in your account in order to do this. Basically, you're getting paid to put on this position, which has a small chance of being like a lottery play, but you're getting paid to do it. So, what is it? You're creating a position that there's a high chance of profit with a small chance to get huge returns. You're selling one far out of the money put, and then you're using the premium that you collected to buy calls on the other side, so far out of the money calls. And if the stock moves up past where you bought that call, you're going to be making a lot of money, and you have a long way for it to move against you before you start losing money. Some pros is like a free lottery play. You're more than likely to get paid to set up this play. It's a theta position if you set it up with a credit. It just takes a while before the theta starts to kick in, so think of it as like a long-term prepping for it. Eventually it'll start cooking, but it might take some time. This should be a low-stress trade because you're selling a far out-of-the-money put on a stock that you wouldn't mind owning at that price. And when you see the P&L graph, you're going to see like you have a large range where you have a profit zone. And then 4, obviously there's the potential for infinite gains if the stock moves up the direction you called it. But you played it safely and you got paid to play this position. This play, I'm going to be calling it a homeless option because I think that sounds cool. I think it's actually called a risk reversal. Why buy a lottery ticket when you can be paid to get one? Okay, so risk. This is not a risk-free position. So the downside of this position or this play is that you might be forced to buy a stock at a price that you said you'd be willing to do that at. So your risk is that your sold put ends in the money. And if you're okay with buying shares at that price, then you just got paid to buy it at that discount. If you run a no assignment strategy, you can turn around and roll this put like you normally would any other naked put that you sold. A comparison to an at the money put, a small move against you will wreck you, whereas with the homeless option, it has to move a large way to get to you, and you see that when I show you a graph of one that I just put up. Here's a graph of one I put on for Alibaba. This goes out to November. And what I did is I sold the 120 put. I bought the 195 call. And I did this for a credit. So as long as Baba stays above 120, I make about $130. If for some reason Baba does decide to move back up to where it should be, above like 200 or something, you can see the gains just go up exponentially as though you just had a bought call. So if Alibaba went back up to 2,000, that would be a $5,000 gain, and I was expecting a profit of $130. So we'll see how that plays out. But this is why this play is really cool. You get this nice P&L, and you're far out of the money. You have a large zone where you make a profit, and you still have that upside infinite gain potential if the stock really does skyrocket. Here's a picture from Interactive Brokers of what this play looks like. A 30% move to the upside. This would be a $2,500 gain, and it would take a 30% move to the downside and get down to 111 to be a $1,500 loss. The break even on this particular play is actually 119.84 because I received a small credit for this position. You see the profitability. Profit is 94%. Max return is infinite, just like I said. Interactive Brokers doesn't know what the aggressiveness is because they're like, what are you doing here? We're running homeless options over here, IBKR.
If you're liking this content, go ahead and click like, subscribe, and turn on notifications so you stay up to date on any videos I put out.
Now, the margin impact, I put on 2 of these, and you can see it took up like 1,400 margin maintenance to put on 1 of these. I put on 2. So, yeah, it's a low margin impact play too. It's just that you're most likely just going to get the profit for the stock staying in between this range here. So it's a small gain percentage, a small win. And if you're looking for huge returns, this isn't the way to do it, but you still have that lottery play. DTE, you can do whatever timeline you're comfortable with. I've mostly seen other people do this on leaps, where you sell one leap, and then you use that premium to buy an out-of-the-money call on the same expiration date, or they might even go further out of the money and buy 2, so they sell one leap to fund 2 calls. I prefer smaller DTE because then, this could still be a theta position. Even if it is minimal, I'd rather have theta still kind of chipping away a little bit at a time. Obviously, if you do this for 30 days or less, theta will burn quicker. If you do more, than 30 days. It'll take a while before theta starts cooking or starts chipping away. The shorter time you have, the less chance of you getting that max gain for beating your call side. So you just find whatever feels right for you on this play. And at the end of this video, I'm going to jump into Thinkorswim and kind of show you more what this play looks like. Utility, you can customize this position even more if you want to. So once you put on your homeless option, if you are having second thoughts about the put position, you can buy a further out of the money put to limit your loss on the downside. And since you're going far out of the money, like it should be pretty cheap to buy that. And if you do that, you might want to buy a further out of the money call so that you still receive a credit for putting on this play. Or you could do this for a debit if you really think the home run's going to hit. You can increase your min profit. And what I'm talking about that is, if we go back here, like the area between your two calls here, you can increase the gain from that by selling a covered call against it. And this will increase the profit you get if the stock stays between your put and your call option. But it'll also limit your max gain if the stock moves past your call option. I already mentioned this, low margin maintenance requirement. So your margin requirement is going to be based off of your sold put. Since that's far out of the money, that should be very small because you're playing at like a 5%, maybe 10% probability when you're selling that put. So the further out you go, the less maintenance it takes. Now that can expand if you don't buy the put protection, but depending on how far away from the stock price it is, you might not need to worry about that. Just be aware that it can expand over time. Things to look for putting on this trade. If you're extremely bullish or bearish on a position, you can do this. You can do this by selling the call and then buying a put if you're bearish to create the same kind of P&L but in the reverse direction. Do this if you're okay with picking up a small gain. Like if my money is just sitting there in cash and I just want to get something on to get a small gain working for me, I'm fine with a small win. I don't need to hit that home run every time, but it still leaves that chance for getting that home run. Since you're selling the put, you want to be okay buying the stock at that price. So worst case scenario, you're buying a stock that you wanted to buy anyway for a huge discount and you get paid for doing it. So when selling a put, like when you're setting up the homeless option, still think of the put first. Like, would I be okay buying the stock at this price? If the answer is yes, okay, then let's go ahead and maybe we want to do the homeless option. And this fourth thing is just Wall Street bets, they like to buy out of the money calls and puts. So it's just kind of, well, they ran out of money. You can sell a put to fund your Wall Street bets 8 play. Let's go ahead and switch to Thinkorswim now. And we'll get this on full screen. So this is actually a play I put on yesterday. And this runs until November 19th. And if you watch this blue line here, you can see where the profit and loss is. So between 120 and 195, if Baba stays between those, I make 130 bucks. But the second it gets past 195, you can see the gain just go up like really fast. I think Baba could go up to 220, so that's kind of where my lotto play would end. So if that does pay off, that'd be about $5,200 in my pocket if it gets back up to 220 by November 19th. If it doesn't, I'm fine as long as it stays above 120. And if it gets below 120, even then, I'll be fine buying Baba at that price anyway. So that's why this feels like a free lottery play for me. If you want to see like the percentages, let's go ahead and jump over to the option chain here. So I sold the put, the 120 put, and right now the delta is at 0.1. So there's a 90% chance that the put option will expire out of the money. So we go back to here, sorry, misclick. So there's a 90% chance that Baba will be above 120, so anything from here to the right is what we expect, and that's all profit zone for us. If we go back here, the call I sold was the 195. If you look at the delta, it's 0.15. So there's a 15% chance of the call option finishing in the money, which means that there's actually a 15% chance that we'll hit this profit area and start seeing those huge gains. So 9% chance of making money and a 50% chance of hitting a home run. What could be better? That's why I'm looking at this. You can also do this with doing like on leaps. I've seen Matt Money did this on XM a long time ago, and simply all that is him. What he did was he sold some puts at a strike that he thought was going to be safe. I'm just going to pick some here and just pretend this is it. And then you can see he's collecting $480 per contract here. So he bought calls for less than that price. So let's find one here. Wow, there's some pretty big spreads here. I'm just going to do the 70 just to show you like how this would be set up. Although I assume you'd be playing a lot closer than money. So he'd be receiving a credit for doing this, and he gets 5 call positions. And if you look at the risk profile, you see you get a similar thing that we just showed you. Again, you got that max or that min profit. If it stays above 44, you're gonna be making $450. If for some reason it gets past 70, you're gonna be making gains really fast. A $1 move passes $1,800 in your pocket. So it lets you buy calls so that you can get a big home run if you want to. So it's just using the premium that you get for selling the put to fund buying the calls. And you do that if you're extremely bullish on a position, or you flip it, you sell calls and buy puts, except that would be a bearish position. And if you know me, I hate naked calls, so I'd be buying protection to, limit my loss in case it goes up against me. So just something to think about. If you like this content, go ahead, like, subscribe, and I hope you guys had a good week. Until next time.